Ladies and gentlemen, good day and welcome to the IDBI Bank Q3FY22 Earnings Conference call hosted by ICICI Securities Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Renish from ICICI Securities. Thank you, and over to you, sir.
Hi, thank you, Aman. Hello and good evening, everyone, and welcome to the IDBI Bank Q3FY22 Earnings Conference call. From the management team, we have with us today Mr. Rakesh Sharma, MD and CEO, Mr. Samuel Joseph, Deputy Managing Director, Mr. Suresh Khatanar, Deputy Managing Director, and Mr. P. Sitaram, AD and CFO. We'll start with the opening remarks and then we'll open the floor for Q&A. I would like to thank the management team for giving us the opportunity to host the Q3FY22 earnings call. I will now hand over the call to Mr. Rakesh Sharma for the opening remarks. Over to you, sir.
Thank you very much. And good evening, ladies and gentlemen, and hearty welcome to this analyst meet for the Q3 results. Yet one more quarter when we are having virtual meeting. It's my pleasure to present to you the numbers for Q3. The bank has shown consistency in growth and improvement in the financials despite challenging position created by COVID-19. The performance has been better than the guidance given at the beginning of the year, and we are quite confident of improving the performance further. So just a few highlights I will mention to you, and then after that I will hand it over to Mr. Sitaram, our CFO, for making the presentation. The bank had earned a profit of 578 crore, which shows 53% increase YOY, and there has been 31% increase in net interest income. Of course, there has been some extraordinary 353 crore of income by way of income tax refund. Even if we exclude that, there has been 11.6% YOY growth in income. And the net interest margin also has increased to 3.88%, and after excluding that income tax refund, it will be 3.31%. CASA is 54.71%, and CASA growth has been 11%. The NPAs, the assets are quite stable. Net NPA was 1.70, marginally lower than the previous quarter, which was then when it was 1.71. The capital adequacy has been quite robust, and the collection efficiency has been 96%. Despite this COVID situation, we have been able to affect reasonably good recovery of 900 crores, and also we have been able to maintain our collection efficiency at the 96%. In fact, there is improvement, and the SMA numbers have declined as compared to September quarter. Now the area which little bit remains is the growth part. Of course, there has been growth in our structured retail assets by 4% YOY, and retail portfolio, when we include retail, agriculture and MSME, there has been 5% growth. And of course, we are targeting 8 to 10% growth. Let us hope, because this COVID has slightly affected the growth part. And secondly, partly the growth has gone towards the NCDs, because some of our good clients, they are availing the facilities of NCDs, so which is parked in treasury, and so that's why this growth appears to be muted here. After 4 years of our that PCA period, and now after 1 year of that, first time we have shown 12% growth in our mid-corporate advances, and this mid-corporate advances was our focus area also. Now, the way we have strengthened our sanctioning teams, we are quite confident that going forwards we will be able to show reasonably good, very calibrated growth in advances, which will ensure the good quality assets. Just to mention 2-3 things about the guidelines which we had given. So I had indicated that our slippage ratio will be less than 3%. I can mention that, at the end of the 9 months, it is 2.80%. Similarly, credit cost, which we had promised up to 1.75, it is annualized basis, it is 1.60. And cost to income ratio for the 9-month period is 43.59%. So that way, whatever we had promised at the beginning of the year, including ROE and ROA, we have been able to surpass the numbers and show better improvement. So that's why going forward, I am quite confident that next year also we will be able to show the better improvement. Of course, the guidance for next year will be given to you at the presentation of Q4 results. Now with that, I will request Mr. Sitaram, CFO, to make a presentation, and after that we can take question and answers. Thank you very much. Thanks for being present here. Yeah, Mr. Sitaram, over to you.
Good afternoon to all of you. Now the MD has covered most of the high spots, so I will not spend too much time on this. If we go to the presentation, slide to 5, page 5, out of the operating highlights, most of it has already been covered by the MD. We want to say two more things, that CASA ratio has maintained, slightly improved to 54.69. Cost to income for the 9 months is 43.59. And overall the retail corporate ratio is at 63.37, which is also almost the same as in from September. So we have been able to maintain all this, and including a PCR of 97%, including technical written-off cases. If we go to the next slide, this is what, just briefly, the PAT has grown 53% year-on-year and 2% quarter-on-quarter. The overall operating profit has also gone up by 31% quarter-on-quarter, and NII has grown by almost 30%, whether on quarter or year-on-year. Overall, the NIM therefore has improved. As MD mentioned, even if we take out that interest on refund of income tax, still we are well above 3% as far as NIM is concerned. The cost income ratio, as I said, is below 43.59. I'll quickly go to the next slide. Here we are saying that the net NPA has, despite this quarter, we had the slippages. One is from the divergence which we disclosed in as part of the stock exchange disclosure after receiving the report. Plus we had one bigger the corporate case and some retail cases. Despite these slippages, we have maintained the net NPA at 1.7% as compared to the same ratio which was there in September. And GNPA has also slightly come down on the back of the technical write-off that we have done of about 1150 crores. The capital is of course quite comfortable. I'll now go to slide 9. This is the breakup of the PL. As you can see, the first feature is of course what is with the declining market rate, both the interest income as well as the interest cost, both are trended down. But we have been able to maintain an improvement in the NII. In this improvement in NII, again we repeat that though there is this 353 crores of interest on refund of income tax, even if you exclude that, we are still at a good improvement over the corresponding period. I can give you the figures as we later go on. Now the other income, at the last quarter meeting, I had said that the recovery from write-off cases is now to be classified under provisions and contingencies, and we had presented like that. But after that, RBI has again amended its master circular. So now that line item has come back to other income, we have regrouped even the previous year figure also in that. So overall, the other income has shown an improvement. One feature was that in the Q3 of last year, we had a sale from the gain from sale of strategic investment. That of course there is no repeat here, but we have certain amount of recovery from return of cases. But if we exclude these one-off also, there is an improvement in the other income overall. Then coming to the OPEX, we have seen some amount of uptick in the OPEX, broadly under the employee cost, the increase is because we have enhanced the family pension rate in line with the industry, what other banks have already done. Then also the subscription to NPS has been enhanced. So we have taken not only the period cost, also from the effective date to now the accumulated cost also. Therefore, there is a amount of one-off there. And in the employee cost, the valuation of the retirement benefit, some amount of provision has come for that. Plus, in the other operating cost, there is a small increase, mainly because of the increasing level of operations as we come out of PCA and certain other marginal items. There is no major cost for this increase in other operating costs. Then coming to the operating profit, there is an increase of about 42%, that is year on year. And operating profit, if we remove that strategic gain sale, then we have shown an improvement of about 58%. Provisions and contingencies will come to it in a little more detail later. Overall, the profit PBT, as we already discussed, there is an improvement of 42% and PAT has improved by almost 100%. Interest income increases, as I mentioned, this is the breakup. Advances income has gone up. We also have improvement in other interest income. That's where the interest on refund of income tax is included. And all the income trends are in the same way that they have been trending in the previous part of the year. NIM has improved now to 3.65%. Now, of course, this next slide, page 11, it shows the build-up of how this percentage improvements have been contributed from various segments. It is quite self-evident here. So I will move on to the next slide. This is the provisions and contingencies, and spend a couple of minutes on this. First is on the depreciation of investment. Again, there is nothing unusual or big here. These are all normal movement in provision. The provision for NPAs, we have provided for the calendar provision, and also we have provided for the divergence that has been identified in the report, plus that the slippages, of course, during the quarter. The provision for standard assets, again, there is a negative here. The negative is because there is one case that we have provided earlier that has moved to NPA, now as part of diversion. Therefore, that has, in the provision for restructured assets, we have made all the provisions as far as the COVID restructuring is concerned, and that is reflected in the quarter as well as the 9 months. Overall, therefore, the income tax, of course, there is no current tax. It's all the deferred tax as we used carry forward losses for setting off the current year profit. We have done a technical write-off about 1150 crores. That's part of that bad debt written off. Besides the normal settlement and OTS that we do, that is about 230 crores, which is there. So this is the breakup of the provisions for the year. If we come to the next slide, these are the yield ratios. Overall, the yield on advances, in line with the market, of course, we are this is daily average, but in line with the movement in interest rate, overall the yield on advances has come down. But we have been able to maintain the similar control on the cost of deposit. So overall, the NIM has improved to 3.65, and the cost to income has been now remains steady at about 43%. So this is the next slide shows the cost of deposit, which I just now mentioned, that along with the movement in the yield on advances, the cost of deposits and the cost of funds are also trended down. If we come to slide number 16, this is the balance sheet position. Nothing special to mention here. So we'll go on to the next slide. This is the slide 17. The overall deposit the position has come down, but this deposit has come down mainly because we have dropped the bulk deposit. We have increased the CASA both in numeric terms as well as in terms of percentage, and within CASA also the share of savings has increased. So the deposit mix has moved to a more favorable composition over the quarter and as well as compared to the December of last year. And this is also one of the factors why the NIM has improved and the cost of deposits and the cost of funds have come down. The next the slide, it just shows the movement in the individual components of the deposit. I have already mentioned this in the highlight. I will not repeat that. Coming to the advances part, on the composition of advances, there is a growth, albeit in the single digits, both in the retail as well as in corporate. Overall, the composition of the advances and the structure of the advances book has more or less remained stable as compared to September. Now coming to the next slide, this is the PSL. PSL, we are comfortable. We achieved all the results. Now moving on to the investments, which is in slide 22. Again, there is nothing much to mention here. The movement in the SLR as compared to the December of last year as well as September is mainly because that in Q1 and Q2 we had divested some amount of the SLR. The non-SLR, there is a slight increase because we have been lending to corporate now also through the NCD route, and that corporate NCD book is reflecting in some increase in the non-SLR. Then we come to the slide on the COVID provisioning. This is the provisioning which we have been highlighting to you every time. So we have fully provided for all the restructuring done up to December. Plus we also have those additional provisions made which we are not yet taken action. We'll take a call at the end of the year. On the next slide, we are given the how the gross NPAs and the net NPAs stand. We already mentioned and talked about the ratios. Just want to highlight that in DA1 category, we are fully provided for more than 50% of the DA1 loans, and as far as DA2 is concerned, we are more than 80% fully provided. Next one is on the movement. As I said, the first time NPA for the quarter is the aggregate is about 1,600 crore. Out of which there is one corporate case, and then the remaining are mostly the retail. No, there are two corporate cases, sorry. One has been identified through the RBI divergence report and another slipped in this quarter. Both of which we are fairly confident that we will be able to upgrade in the next couple of quarters. Settlements and upgrades are about 520 crore, and that write-off includes the technical write-off that I mentioned of about 1150 crore. Slippage ratio, MD had already mentioned that it is below 3%, and it would have been even less than that, but for that two cases which we are fairly confident that they are doing well now also, but we had to make them NPAs, and we are expecting them to upgrade in the near future. The position of summary of NCLT has been given here. There is not much change in the position as compared to September. Sadly, we are at the same position. Coming to slide 22, that is the 28, the SMA position. Again, there is this has been discussed by MD. That is the significant improvement in the SMA position, both in the corporate as well as in retail, as the combination of the measures taken under the government guidelines as well as the RBI guidelines. Plus, overall, there is an improvement in the position of the borrowers. So, even though we have seen the second wave and the third, but I think successively with the experience gained and with the intensity of the COVID not being as much as it was in the first wave, and the uncertainties having been handled quite well over a period of time, we are seeing a reduction in the stress and an improvement in the outlook. Capital adequacy, which we have given in the slide 30, we are comfortable, I already mentioned. This of course doesn't include the 9 months profit. In the next slide, shareholding pattern, there is not much change, it is the same. The book value is 30 rupees, but if we deduct the revaluation reserve, intangible and the DTA, the book value would be in the range of 17.5. And digital footprint, it is continuing to be quite healthy as part of the customer-induced transaction, with almost 96% are the digital, out of which the share of this one, the UPI has gone up. This is also a trend that is saying that the small volume the transaction, the usage of UPI has jumped. This is, you can say, one of the side effects of COVID over the. Now, I will not discuss too much about the financial inclusion part. This is more or less, these are what the status quo as of September. There is improvements in all this from September to December, but yes. Now coming to subsidiaries again, there is nothing much to tell. All are profit making. They have shown improvement, some little, some more, but all have shown improvement in their performance this quarter. On the guidance, I think MD has already discussed. I will not repeat that guidance. It is given here. So I think without the further ado, I'll leave the floor for questions.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue is ready. Anyone who wishes to ask a question may please press star and 1. Question is on the line of Panti Chala from IDBI Capital. Please go ahead.
Yeah, sir. Thank you. Thank you for giving me the opportunity. Few questions from my side. Firstly, on the margin per se, as you rightly said, if we adjust with the one-off income tax refund, the net interest margin comes to around 3.3% for the quarter.
Yes.
So if we try to compare with June against September, there is a decline in the net interest margin on a sequential basis, on a quarter-on-quarter basis. Also, if we compare with the last year FY21, which is 3.4%, there is still a decline. So what could be the margin expectation going forward, as what we are seeing now, cost of funds has completely declined and it's almost near to bottom out, because the GSEC yield showing up move, few banks have shown that increase in the deposit rates. So it seems to be cost of funds are bottoming out. So how should we consider cost net interest margin for us during next quarter as well as FY23?
Yeah, if we compare with the previous quarter, September 21 without this interest on income tax, it was 3.02. So that has improved by about 29 basis points. In the, the third quarter of last year, the comparable figure was 2.88. So that improvement is about 53 basis points.
Okay.
Okay. So if you compare the 9 months figure, again without this interest on income tax, 9 months ended December, the figure was 2.8 and now it is 3.46. So the improvement is 66 basis points.
Okay.
So any way you look at it, there has been an improvement in the NIM. Now coming to the second part of the question, that what will happen when the interest rate cycle starts reversing. So if you look at our advances now, as I mentioned, the new advances that we are given, some of them are through for the corporate through the NCD route, which is not long term. It is more of the medium or a short term. And also on the retail side, we are well placed to pass on this the interest rate cycle as it reverses onto the advances side as and when, because most of the advances are linked to our RLLR, so or other floating rate. So we do not apprehend that the catch up will be so delayed that it will impact the NIM. Yes, but there will be a factor that as we grow, the rate of growth is the question. We have been focusing on quality of growth rather than the volume of growth. So therefore, it will continue to be moderate. So we will not be under a compulsion to raise high cost deposits at a fast pace. So we will be able to keep a focus on the cost of funds as we have been doing now. It is without doubt the composition will again change. We will take some resort to say bulk deposits or other as we need funds when we go forward, but that's still quite some time away. Liquidity is very comfortable and it is sufficient to fund our the growth story for at least the next few quarters. So we really do not envisage a situation where we will be facing a increasing trend in the cost of deposit, but we are unable to pass it on to the loan side. What we are much more focused on is that we want growth which is of qualitative nature, and that is where we will be focusing our energies on.
So in that case, what one should consider net interest margin for next year as such?
So in fact, net interest margin, as last time at the beginning of the year, I had indicated that it will be more than 3%, and consistently I think we have been able to maintain. So next year, keeping in view, although there is scenarios, the rising interest rate scenario will be there, but as Mr. Sitaram has explained, we will be able to pass it on. So we are quite confident that we will be able to maintain NIM of 3.25 and more during the next year. And accordingly, next year, at the time of declaration of our Q4 results, we will indicate the exact number.
Okay. So secondly, that was very helpful, sir. Thank you. Secondly, on the asset quality front, what we were observing as major impact of COVID-2 for the industry as such was visible in Q1 FY22. So after that Q2 FY22, there was a decline or improvement in the gross NPA or decline in the slippages. But in our case, what we are observing, first time NPA or fresh slippages are consistently Q1 to Q2, Q2 to Q3, there is an increase. And in fact, in Q3, if you observe the settled plus upgradation, kind of a recovery part which we see, is quite low as compared to first 2 quarters. So any specific reason if you can share? Also, in this you have shared that 2 corporate accounts are there. So can you bifurcate the first time NPA? What was the corporate amount? What was the retail and what was the other MSME or such like that?
Actually, you are right. We had indicated that our slippage ratio will be less than 3%, and we have been able to maintain it below 2.80. Now, coming to your question specifically, now that 1,639, the breakup is 1,066 is corporate and 573 is retail. So retail is more or less, in fact, it is better than the estimates, and we have been able to control them. That you will see from the slides on SMAs that our SMAs have come down and the stress has come down. The collection efficiency, as I had indicated earlier, also it is 96%. My total SMA, when I am saying total SMA means including everything, not only for more than 5 crores, everything, it was 3.86% as on 30th September, which has come down to 3.53 as on 31st December. Now this out of 1,066 of corporate, 900 crore are 2 accounts, which are, one is of course as we had indicated, one was because of divergence and the other one due to some commencement of commercial production. Both the accounts are that which are regular as far as repayment record is concerned, but on technical grounds these have been classified as NPA, and we are quite hopeful that these 2 accounts will be upgraded either in this quarter or the next quarter. So, but for this, I think our slippage ratio would have been less than 2%. In fact, it would have been 900 crore if we exclude. The corporate slippages are only 166 crore. So it's a one-off situation, and we are not much strained about that because we know that these 2 accounts will be upgraded either during this quarter or next quarter, and these are only due to technical reasons. So, but I can assure you the slippages and the slippages are under control, and our recovery position and the systems which we have established are quite robust now, and we do not expect much slippages in near future.
Thank you very much, sir, for that. So lastly from my side, if you can share the one single data point, outstanding restructured standard advances as of December 31, be it 1, 2, all inclusive, but as of December. What will be that number, and against that, what will be the provisioning we have?
Yeah, just 1 second. We'll give you that figure.
Yeah, actually, this I have this number immediately available. Sitaram will find out in the meantime that this COVID which we have restructured, this other than COVID, he will give you a number. During COVID season, as per RBI instructions, we have restructured the advances. That amount is around 4,436 crore, which is 3.5% of our total standard advances. So it is like, it is again as per, which was our estimate that it will be in the range of 3 to 4%. So that there is, and these accounts are regular. As such, there is no problem. Other than this COVID, Sitaram, any other numbers are there with you?
Yeah. In fact, that S4A and Fiber 25 aggregates to 3,495 crore.
So 4436 plus 3495. Can we say like that?
Yeah.
Yeah, that was very helpful, sir. Lastly, sir, ECLGS scheme, what is the outstanding amount, the ECLGS disbursement what we have done, the loan amount total towards ECLGS?
About 2,000 crore.
Okay. And how the collection efficiency in this is happening in ECLGS loan book? If you can share.
At 96%.
Okay, similar on an overall basis kind of thing. That was very helpful, sir. Thank you very much, sir.
Thank you. Anyone who wishes to ask a question at this time, they may please press star and 1. Next question is from the line of Pranav Tendulkar from Red Enterprises. Please go ahead.
Hi. Thanks a lot for the opportunity. Sir, the two corporate accounts that you mentioned, they totally constitute for the total 1066 crore of corporate slippages that you mentioned, or is there anything else? So this
out of the total corporate slippage, that two accounts are about 970 crores. Then there are another 3 accounts which are in aggregate less than about 100 crores.
Okay, so this 970 crore will be, you are saying that, upgraded in the next quarter?
No, the next quarter or the quarter thereafter.
Okay, two quarters.
They are on strong footing. They're doing quite well, and overall they're regular.
Correct. Sir, recovery and upgrades for the next quarter or for the year could be how much?
For the next quarter.
Next quarter or next 6 months, or anything that you can.
Actually, to be very frank, we had fixed up a target of 4,000 crore recovery and upgrade recovery for the full year. As against that, we have already achieved the target of the actual number is 4,334 crore. In fact, the year-end target we have already achieved. Another around 700 to 800 crore I am expecting. So we will be able to achieve total full 5,000 crore of recovery during the current financial year. And apart from that, there will be some upgradations also. If these two big accounts are upgraded, that will add to by substantial amount. But if not, otherwise some 300, 400 crore every quarter there are some upgradations are there.
Right. Sir, just a query. So in your presentation where you present the business performance and advances, so there are two values. First is, what is the services business, like loans to services sector? So if you go to slide page number 19, on the bottom right hand chart there is a pie chart which shows the advances. So 58,574 is the industry advances, then 24,889 is service. So what is the services?
It's more of trading.
So it will be SME, MSME? Traders? Right.
Yeah, we'll get back to you.
Both in the SME as well as also agriculture service units.
Because there will be services rendered both in agriculture, MSME also, okay, and then there will be some amount of services in corporate side also. Let me get back to you exactly because these are for that RBI definition.
Yeah. Right. Then there is one more doubt. In the same slide, in that pie chart, you mentioned that personal loans is 52,086 crores.
Personal loan, okay.
Personal loans. But in the bar diagram above, in structured retail assets, you say that September 21, total retail assets is 60,093. So what is the difference?
Yes, first of all, our personal loan portfolio is not that, definitely.
Portfolio is only 507.
500 crores is our personal loan portfolio. I think if you look at that, the light blue color in the bar chart, the first top tier, 540 is the personal loan.
Correct.
Compared to 514 and 582 in December 20. That's the movement in the personal loan. Correct. Aggregate is the gray figure is the right hand side, 59, 123, 60, 61. Okay. Then what is your question exactly in this?
So even that 60,093 doesn't match with the personal 52,086 in the pie chart.
Yeah. This personal loans is something else, I think, in the advances.
So can you just modify this slide because it confuses, because the balance sheet advances are just, I think, 130 around.
Yeah. This is personal. If you look at it, that is 536.51. Okay.
Correct.
So what has happened, I think, because of that decimal thing, I think the pie chart has got distorted. So thanks for pointing it out. We'll correct that. But the figure is right. That 536.51 is the figure. Only that the graph is wrong because the decimal got missed out and therefore the overall sharing has got affected. It definitely the share of the pie is not that. It is much very small. Thanks for pointing it out.
Right. Sir, also in the employee expenses of 859 crore, can you just explain what is the impact of that family pension adjustment? That is one. And what could be so this, obviously this quarter contains the prior period adjustments, and that is why what could be the normal quarter run rate going forward for employee expenses?
Yeah, employees, we have provided for 3 quarters. We have provided 50 crores is what we have provided for 3 quarters. So on an average per quarter, you can take it as 17 crores.
Right. So in last quarter, say 698 crore plus 17 crore could be the employee expense going forward. Is that right? Or?
I mean 17 crores is what would be in the last quarter, yeah. I mean per quarter. So we have provided for 3 quarters this time. Therefore, 2 quarters will not be repeated.
Right. But even if we just exclude, say, 51 crore from 859, still it is 808 crore versus 698 crores last quarter. So is there anything else in this?
Yeah. Then there is the NPS also, the National Pension Scheme. There also we have enhanced the contribution. So that impact from the effective date to now has also been taken into account.
Right. And what is that impact? How much?
That is about 150 crores.
4 crores per month.
That is 4 crores per month. So it is 1 year impact, 50 crore is what we have taken.
Right. So can you just tell what will be the quarterly expense going forward when this abnormal adjustments are not there, roughly?
So 4 crores per NPS, that is plus after the 4 crores is the announcement, then the normal run rate, plus similarly for the family pension, that together will be how much is it? 90 plus 17 plus 4, around 720. About 720, but say the normal run rate would be about 720 overall and the aggregate. But you will have to keep in mind that the AS15 plays a role here. This time there has been a valuation hit of about 120 crores due to 67 crores, sorry. 67 crores.
So, like, as Sitaramji has clarified, this salary structure consists of 2 parts, as you can see. One is that, salary and other benefits, and second is that AS15 provision. Now, this AS15 provision depends on that 30-year interest rate. Now, that keeps on varying. So, if the rates are increasing, then, we may not be required to make any provision on that. If the rates are declining, there may be provision. So, that will keep on varying. But the salary part structure is that because this time we have provided for 1 year, I think more than 1 year for NPS arrears, and then this 3 quarters family pension. So apart from that normal expenditure will be there, which will be in the range of around, say, same 720, say, roughly 725 lakh crore. So that AS15 provision we cannot predict at this juncture.
Good.
Only we cannot take back a provision. So if there is a favorable movement, there will be no provision made.
Right. So just last question from my side. Previous quarter you had provided details of 983 crores of other income. Similarly, can you provide this for this quarter, December, and last year, same quarter, December? And if possible, can you include this data from next time onwards in PPT itself so that we don't have to waste time?
Yeah. I mean, you want the breakup of the other income, is it?
Yes. So it will be core fee, treasury, revaluation, forex, recovery. These were the items just last time.
Okay. And wait, I thought we had given that. 1 second. We had given that. Okay. So as far as the commission part is concerned, okay, for the quarter, it is 450 crores.
Right.
And 9 months, it is 1290 crores.
Correct.
Okay. Then on sale of investments, it's 151 and 1046.
Right.
Okay. Then revaluation of investments is small, that is 3 and 63.
Right. Forex?
Then on forex, it is 171 and 505.
Right.
Then the other major recovery from write-off is 308 and the 777.
Right.
And miscellaneous income is 65 and 142.
Perfect, sir. Perfect. And same numbers for last year, same quarter, December 20.
Same way, I will give 3 months and 9 months.
Yeah.
Okay. Commission and brokerage 460 and 1228.
Right.
And profit on sale of investment 641 and 1631.
Right. 1631.
1631, yeah.
Perfect.
Then profit on revaluation of investment 72 and 7.
Right.
Then the forex is 84 and 147.
Right.
Recovery from written-off cases 105 and 279.
Right.
Miscellaneous income 70 and 145.
Right. Perfect.
Okay. And if we have taken the suggestion, we'll include this in the presentation.
Yes. Thanks a lot, sir. Thanks a lot. I'll come back if I have other questions. Thank you.
Thank you. A reminder to our participants, if you wish to ask a question, please press star and 1. The next question is from the line of Renish. Please go ahead.
Yeah, hi, sir. Just, sir, couple of clarification on this corporate accounts. Sir, what would be the systemic exposure?
Sorry, can you repeat that?
Yeah, sir. So the corporate account which has slipped in the Q3, what could be the systemic exposure of these two accounts?
Sir.
Everybody has not downgraded.
See, the one issue that on the divergence part, RBI does it selectively for each bank as part of that inspection.
Time gap. There's a time gap between their reports. So what we have downgraded in Q3 because of a divergence, other banks in the consortium, according to our knowledge, nobody else has done so far.
Yeah, so I'm just trying to understand what could have triggered, let's say a regulator asking us to downgrade while rest of the industry is still not downgrading. I mean, it is just a quarter away from where system will also downgrade, or it's a technical thing and hence you are saying the same account will upgrade in the next quarter?
We are not sure what will be the regulator stance, because everybody gives representations also, including us. We gave a representation, and others also, as part of their inspection reports, they give a representation. So RBI may have a reason, we don't know. But as of now in Q3, I think we are the only banks who had downgraded that account based on RBI.
Okay. So I mean, it is right to assume it's a 90 DPD plus account?
No, this was an old restructuring, and according to the banks, all the banks, some 9 or 10 of them, all the conditions for restructuring were met with, and the account was upgraded by us in March. RBI had a difference of opinion, and they said you shouldn't have upgraded and hence downgrade again.
Got it.
Upgraded, but others are maintaining that upgraded status. So
otherwise, there are no dues in this account.
Got it, sir. This is,
actually, there are no overdues. Rather, 1 year in advance they have paid. So DPD wise, that wise there is no problem, no overdue.
Got it. So this is a pure technical reason.
That is why we are quite confident that it will be upgraded either this quarter or next quarter.
Got it, sir. Pretty much clear, sir. Yes, sir.
Thanks
a lot for the clarification. Just last part. On this new investment valuation paper which RBI has put out, do you guys foresee any negative impact on PNL once it gets implemented?
On the other hand, I feel that there will be a positive impact.
Okay.
As of now, the method is that you don't recognize any upside and provide all downside.
Correct.
This is moving more towards IFRS, the index version. So though it's not completely in alignment with index, but still it is moving towards that, which means that there could be a recognition of some of the upside, which so far banks are not allowed to.
Got it. Yeah, sir. That's it from my side, sir. Thank you so much.
Thank you. Anyone who wishes to ask a question at this time, they may please press star and 1. We have the follow-up question from the line of Pranav Tendulkar from Red Enterprise. Please go ahead.
Hi, sir. Thanks a lot for the opportunity. Sir, could you just give some detailed view on how loan growth is looking forward in both retail and corporate accounts? Thanks a lot.
Yeah, Mr. Joseph, can you take it for wholesale and retail? I will request Mr. Suresh Khatanar. Kindly, Suresh, you mention about that co-lending steps we have taken, agreements and all these things. So kindly explain. Mr. Joseph.
Yes. So overall, as MD mentioned this time and also in the last times, our target for this year, asset growth target, has been 8 to 10%. And within that, we are confident that by Q4 we will achieve, though as of now Q3 it is at 5%. Now on the corporate side, for Q3 year on year we have grown by about 12% on the mid-corporate side. On the large corporate, it is there is a slight negative growth. But if we were to take the NCDs, because during the last 2 quarters there has been a heightened activity in the non-convertible debenture market, and some of this, as you are aware, were also eligible under the TLTRO scheme of RBI, which ended on December 31st, to be put under the HTM bracket also. So we have also picked up some quality paper in the primary market for that. That is of course showing in our investment book and not in the credit book. So overall, MCG we have grown by about 12%. The large corporate is stagnant. But at the end of Q4, I think we will be able to grow the corporate book also by about 10%.
As far as retail is concerned, see, large portion of, when we say retail, it is a RAM. So large portion consists of our home loan, where the growth has been already 7% YoY basis. And the disbursements over last 2 months have started picked up. Because of the activities also has picked up in these things. So these are growing rapidly. On the SME front and the agriculture front, also there is a pickup. On the SME front, now we have entered with 3 partners in the co-lending. So that push is additionally coming. And good quality of the microfinance lending is also happening on the agriculture front. There's a good momentum on the gold loan book also. So that is also a part of the agriculture loan. So that is also growing. So I think we should be able to maintain the momentum there on the retail.
Right, sir. And going forward, how is it looking for, say, next 12 months?
12 months, I think we will continue the strategy which we have adopted, and our focus on granular business and the quality business will grow. So we are looking at a minimum of 10% growth.
Right, sir. Thank you.
Thank you. A reminder to participants, please press star and 1 if you wish to ask a question. The next question is from the line of Vishal Gupta from Bernetta International. Please go ahead.
Hi, sir. Good afternoon. Could you please elaborate on this co-lending arrangement that you've spoken of?
So co-lending arrangement, we have entered with 3 partners, and one is already activated. What more details you would like to know, sir?
What is the size of the lending that you've done so far through the co-lending partners, and how do you expect it to track over the next, let's say, year or so?
So these are recent additions. We have already signed up for about 100 crore to begin with the partners, but this we will grow. There are some 2-3 other partners which we are talking to, and we expect this book to be about 500 crore in the next year.
Right. Thank you.
Thank you. Ladies and gentlemen, that would be our last question for today. I now hand the conference over to the management for their closing comments. Thank you, and over to you.
So thank you very much, and ladies and gentlemen, thanks to all of you for the active participation. I hope we have been able to answer to your questions. But if you still have some questions, so kindly feel free to send email to either me or to Mr. Sitaram, CFO, and we will be very happy to clarify on any issues. Thank you very much, and happy weekend.
Thank you very much. Ladies and gentlemen, on behalf of ICICI Securities, that concludes this conference. Thank you all for joining us, and you may now